Welcome back to The Explainer. All right, let's talk about something that drives us all nuts. You get some big news and you're trying to figure out what the market is actually doing. What's the real story? I mean, you've seen this, right? A company just crushes their earnings report, the news is fantastic, and the stock just sits there. Or worse, it drops. It's enough to make you pull your hair out. It feels totally random. But what if it's not? So, you basically have two types of people in the market. You've got the news reactor, who's just reacting. They're on an emotional roller coaster, chasing the price up and down, and honestly, they're just confused. Then you've got the systematic analyzer. This person is different. They're seeing patterns in what looks like total chaos. And our goal today is to help you move from that first column to the second. See, the market isn't just a bunch of random noise. It's actually telling a story. And this explainer, well, it's all about teaching you how to read that story. We're not going to focus on the headlines. We're going to learn to read the real language of the market, the price and the volume. All right, let's get into the good stuff. The first thing you need to know is that the market's reaction to news isn't just total chaos. Nope. It actually follows a pretty predictable pattern, a three-phase pattern to be exact. And once you get this, it's like putting on a new pair of glasses. So here's how it plays out. First, you get that initial reaction. This is like the first 30 minutes. It's pure emotion, right? It's algorithms, it's knee-jerk reactions. Then things start to calm down a bit in phase two, what we call institutional absorption. This is where the big money, the institutions, spend the next few hours actually digging in and figuring out, okay, what does this news really mean for the company? And finally, after all that, phase three kicks in, the trend development. This is the real sustained move that plays out over the next few days or even weeks. Okay, so theory is great, but let's look at a real-world example. We're going to zero in on that first phase, the initial reaction. And we've got a perfect case study, Infosys, and their Q3 earnings from back in 2024. They dropped what everyone thought was great news, and boy, did the market react fast. And here you can see that emotional surge perfectly. I mean, Infosys beat their profit estimates, they raised their guidance, everything you want to hear. So the stock gaps up a huge 8% right at the open. But look at the volume. It just exploded 5 times the normal daily average. That right there is the classic signature of that first powerful emotional reaction. Okay, but a big price move, that's only half the story, right? To really know if that move is the real deal, you have to look at the volume. Think of volume as the market's language of conviction. It's what tells you if the big institutional money is actually backing the move, or if it's all just a bunch of temporary noise. This table is basically your decoder ring for the market's language. It's so important. But look at the first line. High volume plus a strong move, that's what you want to see. That suggests a genuine fundamental shift is happening. But a big price move on low volume, whoa, that's a massive red flag. It's screaming temporary overreaction, and it's probably going to reverse. This is how you start to see what the market is really thinking, not just what it's shouting. So when you get this powerful cocktail of price and volume, it often leaves a very distinct fingerprint on the chart. We call it a gap. And you shouldn't think of these as just empty space. They're like punctuation marks in the market's story. And just like a comma is different from an exclamation point, not all gaps mean the same thing. Not even close. Let's start with the big one, the breakaway gap. This is the heavyweight champion of gaps. It's when a stock doesn't just move up. It literally leaps over a huge resistance level, and it does it on massive volume. This is the market screaming at the top of its lungs, hey, everything's different now. A brand new trend is starting, and we are not looking back. All right, next up is the continuation gap. This one is a little different. It happens in the middle of a trend that's already going. Think of it like the market is just confirming what it's already doing. It's a confident little nod that says, yep, we still like this direction, let's keep going. Okay, pay close attention to this next one because it's a trap so many people fall into. It's called the exhaustion gap. This happens at the very, very end of a long run-up. You see this last desperate push higher, and the volume just goes insane. Everyone who has FOMO is piling in. It looks incredibly strong, but it's actually the final gasp for air right before the whole thing collapses and reverses. And last, we have the common gap. And just like the name says, these are, well, common. They happen all the time, usually on low volume. And they don't mean much. They're basically just market noise, a little blip that usually gets filled and forgotten about really quickly. So here's the bottom line, the really crucial takeaway. Not all gaps are created equal. And this table proves it. Look at that breakaway gap. Only a 15% chance of ever getting filled. The market moves on. But that exhaustion gap, it has an 85% chance of filling. That is a huge difference. So this tells you which gaps you need to respect as a real fundamental change and which ones you should probably view as a trap. Let's put it all together with this HDFC Bank example. It's picture perfect. So you've got the stock building pressure, winding up tighter and tighter right underneath a big resistance level. That's the technical setup. Then, boom, the catalyst hits. They beat their earnings. And the outcome? A clean, powerful breakout on 3 times the normal volume that kicked off a 12% rally. That's the magic formula. A great technical setup meets a strong fundamental story. Okay, so we've covered a lot of theory. The phases, the volume, the different kinds of gaps. Now, let's turn all of that into an actual practical framework. How do we put this into action? First things first, let's do a quick reality check. You've probably heard that old market saying, all gaps get filled. Well, I'm here to tell you that's a myth, and it's a dangerous one that has cost traders a ton of money. Because as we just saw, those powerful breakaway gaps, they often don't fill, ever. So how do you tell the difference between a real breakaway gap and a fake out? Well, here's a checklist the pros use. You've got to ask these questions. Did it blast through a major resistance level on at least 3 times the normal volume? Check. Does the news actually justify a real long-term change for the company? Check. Can you see signs of big institutions buying in? And this is a big one. Is the rest of the sector and the whole market moving in the same direction? When you can tick all these boxes, your signal gets a whole lot stronger. And on the other side of the coin, I want you to burn this number into your brain. 85%. That is the probability that an exhaustion gap, that crazy parabolic final buying frenzy, is going to fail, reverse, and fill back in. So when you see that pattern, the odds are overwhelmingly high that it's a trap, not the start of something new. So you see, price is so much more than just a number on your screen. It's a story. It's a story being written every second by the fear, the greed, and the cold, hard calculations of millions of people. And now you have the tools to start reading that story for yourself. So I'll leave you with this question. What story is the market telling you today?